Hello and hello once again. Yes. Okay, so this video is just a video to help refresh our minds on what we're actually doing here in Forex. While I was learning, like during the early stage of my learning, during the early curve of my learning process, or during the early stage of my learning curve, I used to have a lot of challenges. One of the challenges I had was that I could not really place all the things I was learning in Forex because sometimes there's a lot to learn and you might have the challenge of fixing everything together, making everything come together with good synergy. Or, it's not like I had a mentor who was teaching me. I was learning from people's paid contents or content I found on YouTube. But over time now, I think it's getting better, for me. And I said, okay, let me help you solve that challenge I had. Right now, I'm going to make my first lecture notes. My first lecture notes here. Okay, so I want to actually let us know what exactly we are in for. What exactly you are in for. Is that correct? Yeah. All right. This is the best way I can name this document. Forex summarized. Okay. So now is that when you're dealing with the forex markets, this video is not meant to be long. It ought to be a short video. Very short video. I hope it's clear enough. Now, when you enter the forex market, the first thing you want to actually do, ask yourself. First, you want to ask yourself, all right, what is the current, what is the current position of markets? That's the question you should ask yourself. I'm not going to show, I'm not showing you any charts in this video. This is just a conversation to help you understand how to synergize things better. Do you understand? The other videos I've made before now has explained it. And the other videos I'll be making after this video will also explain better. Do you understand? Right. Let me make that big. Make that very big. Yeah. So what is the current position of markets? That's the question you should ask. That's the question you should ask. What is current position of markets? That's the first thing you should always ask. So it's either the market is what? In a buy trend, right? If the market is in a buy trend, or if it is in what? A sell trend. Do you understand? So when you enter the market and you see this happening, so when you enter the market, the moment you open a chart, or the moment a friend gives you his forex chart to take a look at, you want to ask yourself, is this market in a buy trend? It's the same thing when I say sell model. When I say buy model, you can still call it your sell trend too. You can sometimes call it also your buy model. Buy model. Do you understand? Or for your sell trend, you can also call your sell trend a sell model. Do you understand? So you open your Forex chart. The first thing, before you start clicking any button, just looking at the screen of your chart, either on a phone or a computer screen, or in the bank, yes, in the bank, or anywhere online, the first thing you want to ask yourself, is it in a buy trend or a sell trend? If it's not in a buy trend or in a sell trend, it's most likely it is most likely in a quiet state. You want to ask yourself, is the market quiet, or is the market in a buy trend, or is the market in a sell trend? When the market is quiet, hmm, when the market is quiet, that's what you call consolidation. Consolidation. Do you understand? That's what we call consolidation. When the market is quiet, we call it consolidation. And that consolidation, you can also call it um, a state of a state of indecision. Yeah. When the market is quiet, you can call it a consolidation or a consolidating market. But you can also say that the market is what? In a state of what? Indecision. So there are three okay, rather than say what is the current position of market, you can just say this. What is the current movement of what? Of markets? That's the best way to put it, I believe. What is the current what movement of what of markets? So is it in a buy trend or a buy model? Is it in a sell trend, which is same thing as what sell model? If the market is not buying or if it's not selling, then that market is what is quiet, or that market is in a what consolidation, or that market is what is in a state of indecision. So there are three movements in markets. All right. So I'm summarizing it now. All right. Three movements in markets that you can get. The three movements are what? Consolidating movements. Because when the market is quiet, it does not mean that the market will not move. When the quiet is indecisive, it does not mean it will not move. It will move, but it will not buy, it will not sell. It will just be like you are just hanging in between. Do you understand? Okay. So this is just a note I'm making for you guys. I see. So these are the three words, the three movements you have in market. In the market space. You see that. Now is that. So moving further away from here, let's go to the next point. All right. The next point, which we want to go further into now, the next point which we are going to now is when you find out that the market is is buying, or you find out that the market is selling, it means that the market is making a meaningful movement. But if the market is quiet or the market is consolidating, in a consolidating movement, the market is still moving, but it's in between. It's not really going up, it's not really going down, it's just hanging in between. That movement is not reasonable to us. It will just give you a headache. Do you understand? So you want to see the market either move upwards in a buy trend or move downwards in a what? In a sell trend. So the next thing you now ask yourself, let's say now you've determined that the market is in a buy trend or the market is in a sell trend. The next thing you want to know is how cheap is the price? How cheap is the price of the market rather, is the price of the market. How cheap is the price of the market at that point in what? At that point in time. At that point in time. All the things we are learning, all what we are learning, break of market structure, POI, which is point of interest, institutional reference points, entry and exit, time management, money management, risk management, all those things we're learning is because of all these points I'm listing out. All those things we're learning is what we use to determine all these things I'm writing out. Do you understand? So you've checked the market movements, right? Then you ask yourself, how cheap is the price of the market at that point in time? So what you want to do is this. What you want to do is this. If the market, now, in the market, if it is a buy movement, if it's a buy movement, or if it's a buy movement, if it's a buy movement, what you want to do is that you want to know you want to know how cheap is the price of the market at that. Yes. So if you find out, okay, I looked at the chart right now, my friend just showed me his chart screen, or I entered a bank, or I saw on the internet, and I just saw a forex chart right in front of me. After checking or determining if the market is either consolidating or buying or selling, the next thing I ask myself, if the market is in a buy movement, I want to know how cheap is the price of the market. If the market, all right, if it's a sell trend, if it's a sell movement, you want to know, all right, you want to know how expensive, do you understand? How expensive is the price? Yes. Now, why we're saying this is that you and I know that when you go to the market and you want to buy foodstuff as a human, as a person who goes to the livestock market or like market, you want to get foodstuff, you want to stock your house with food items, you would prefer to buy things at a cheaper price. Isn't that right? Exactly. So in the natural world, people like to buy things at a cheap price. So in the same way, also in the market space, in Forex, you also want to buy at a cheap price. Do you understand? Also, as a seller in the real world, if you are selling the market space in the real world out there, you want to sell at a high price because you know that when you sell at a high price, you will make a gain, right? You will make profits. Isn't that true? Yes. So the same way in the market space also, when you are in a sell movement, you also want to what sell what at an expensive price. If it's if it's if it's a consolidating movement, consolidating movement, you need to wait or you want to wait. Want to wait. So if you find that okay, the market is consolidating, you just have to wait. All right. You have what? You have to wait. Why? Because the price is neither what? It's neither expensive or cheap. You know, I told you that the consolidating market is in between. It's not like you really have it going up or really coming down. It's just in between. It's just stagnant. It's just hanging in between. Do you understand? So when you determine that okay, the market when you determine the market movements, is it a consolidating movement? Just wait because the price is not cheap. It's not expensive. If the market is in a buy movement, look at the next thing. If in a buy movement, you want to know if the price what is cheap. If the market is in a sell movement, you want to know if the price what is expensive. Do you understand? Then the next thing you want to do is this. Now, the next thing you want to do is this. All right. The third thing you want to do is this. When you are spotted, once you have been able to decide if the market is cheap, that is when you're in a buy movement. When you're in a buy movement and you've determined if the price is cheap, that is, you have determined if the price is expensive or cheap. The next thing you want to do is this. You want to look for a point of reference. Sorry, a point of interest rather. A point of interest. Do you understand? A point of interest. And this point of interest, is the same thing as what we know as the institutional reference point. All right. So you've So the first thing is what? Check the current movement of what? Market, which is this. Once you have determined the current movement of markets, the next thing to know is how cheap is the price of the market. How cheap, or how expensive rather, okay, is the price of the market. How cheap or how expensive is the price of the market. If the market is cheap in price, you want to buy. If the market is expensive in price, you want to sell. Do you understand? If exactly. Okay, let's go ahead. Now, let's say you have determined that okay, the price is cheap, but the price is expensive, and now you want to take a trade in the market. The next thing for you to do is what? You have to look for a point of interest, or a what? Or what? An institutional what? Reference point. It's still the same thing. Do you understand? And this point of interest, or this reference point, they are examples of what we call, okay, they are examples, and you already know them already. FAG is what? Fair value gap. Fair value gap. All right. You have the what? The block. The blocks. What do you find in the blocks? You find things like the order block. That block, litigation block. And what? And breaker block. All right. Now, there are other kind of blocks, but I don't want to mention them. Do you know why? Because if you are paying attention to too much point of interest, or you are paying attention to too much reference points, sometimes you can get confused in the market space. Sometimes it can even become a distraction to you. You understand? We also have another point of interest, which is what? Which is time. We have another one, which is what? Yes. I think I'm skipping one already. We have swing points. Swing points. I think I'm skipping one already. All right, don't worry. Yeah, it's fine. It's okay. Do you understand? So now is that. So once you have determined the current movement of markets, the next thing you want to know is how cheap or expensive is the price of the market. After knowing that, you want to what? Look for what? A point of reference, or what? Institutional what? Reference points. The reason why you have to look for this point of interest, that the point of interest are like positions in the market space. They are like areas in the market space where the big banks do play with price. Do you understand? So those points of interest, the big bank have interest in those areas. So it's also a place of interest for us because the big bank walk around those areas. So those places where the big bank walk around, where they play around price, that is where we also go and take our trade as well. Do you understand? So the next thing on our list is this. The fourth thing, okay, after you have spotted your point of interest, you enter your trade. You enter what? You enter what? Your trade. You enter your trade. Can you see? So when you enter your trade, what you have to have in mind is this. Now, when you enter your trade, what you need to have in mind is this. You want to actually, yes, you want to, okay, I'm trying to make this very, very easy for you to understand. So when you want to enter your trade, what you have to understand is that this market price here at this point in time cannot go back this way. Something. If you're going to take this trade, or you're going to take a trade, the first thing you need to understand, okay, how much do you want to risk? How much are you willing to risk? How much are you willing to risk? That's it. That's something you must always sort out. And we are risking anything in the market space. Okay, you should not risk too much of your account. Maybe at least 1%. It could be 1% of your capital or 2% of your capital. Yes. Or 3%. But I think 3% is big and is I think 3% is okay enough. You can risk 1% and you are good enough to risk 1% of your capital in trading, that's fine. If you can risk 2%, fine. If you can risk 2%, that's okay enough. But at least 3 should be the last point. Do you understand? Okay, what is the meaning? Like, okay, don't worry, I won't go too deep into that aspect yet. But let me just focus on this. So now, when you know how much you are willing to risk when you enter a trade in the market space, the next thing you want to know is your risk to reward ratio. Your risk to reward ratio. Your risk to reward ratio, all right, is how much do you want to risk to get how much? For example, let me give you an example. Do you want to risk? Where's my dollar sign? Show yourself. Okay, that's my dollar sign. Do you want to risk 2%, sorry, $2 to get? Do you want to risk $2 to get how much? Let's say $8. Can you see? That's your risk to reward. That means you are willing to lose what? You are willing to lose $2 to get $8. That is, you are taking $2 from your capital. You are putting $2 at stake. And if the price does not turn out well, you only lose what? $2. But if the price turn out well, you will gain what? $8. Or you could say, okay, I want to risk $10. For example, it depends on the size of the capital you have. You could say, okay, I want to risk $10 to gain what? To gain, let's say, $50. It depends on your own personality. It depends on your own personality. Do you understand? If you are saying, okay, I'm risking $10 to get $50, it means that if the trade does not go in your favor, if the trade fails, you will lose only $10. But if the trade goes in your favor, in your direction, you will gain what? $50. That is the meaning. That's what your risk to reward ratio does for you. Now, the next thing you want to know is, in placing your profits, when you place your profits, when you place your profits many times is dependent on is dependent on you know is dependent on how the market is behaving. Because sometimes you might decide that okay, oh, sometimes because you might be like, I want to risk $10 to get $50, right? But imagine that the market is not so smooth today. You might not wait until you cash your $50 entirely. You can just cash $30 and go. Do you understand? Okay. So after you must have placed your trade and everything, you also need to know how to exit your trade. Yes, how to enter your trade. Enter your trade and also what? And also exit your trade. Your trade. Do you understand? So you enter your trade. Where do you enter your trade? You enter your trade from point of interest. Any of these guys we wrote here, either is fair value gap, either is any of the block, either is a time frame. Time frame. Time frames are also point of interest for us. Time frames and time, yeah, those time frames, they are point of reference for us. So after you found your point of reference, after you found an institutional reference point, the next thing will take your trade and what exit your trade. And that's all. That's all we do here in Forex. Do you understand? That's all we do here in Forex. So let me just recap the whole thing because I'm done with the video right now. It's not meant to be a long video. So when you open the Forex charts, the first thing you want to do is what? You want to know the current movement of markets. Is the market in a buy movement? Is the market in a sell movement? Or is the market movement what? Consolidating. Now, once you're able to determine the movement of market, if the market is in a buy movement, first of all, before you start buying, don't jump into buying yet. Confirm if the market price is cheap. Because you are meant to buy in the market when the market price is cheap. Or if the market movement is in a sell movement, before you start selling, chill a bit. Just try to confirm if the market is expensive in price. Because you are meant to what? Sell at what? An expensive what? Price. But if the market is consolidating, don't buy, don't sell, just wait. Wait for the market to either go into a buying movement or a sell movement. Do you understand? So now, once you are able to tell that, okay, the market is in a buy movement or it's in a sell movement, any of the two, once you're able to tell that, okay, the market is in a buy movement or it's in a sell movement, either buy or sell, then the next thing for you to do now is to look for reference points. The reason why you're looking for a reference point is that your reference point is where you want to what? Take your trade from. You don't want to take your trade anyhow. You want to take your trade at safe points in the market, at safe region that are safe to play with, that will be in your favor. Understand? So these are the reference points, which I will still be teaching you in the videos to come. Then once you find your reference points, the next thing to what is to what? Take your trade. Simple and short. And when you are taking your trade, you have to ask yourself, how much do I want to what? Risk? Do I want to risk 1% of my capital? Do I want to risk 2% of my capital? Do I want to risk 10% of my capital? The moment you determine that, that takes you towards your risk reward ratio. Am I losing $2 to get $8? Am I losing $10 to get $15? Then when you place your trade, you also set your trade where you want to leave the market. You understand? So how do you do that is that you set your what? Your stop loss. and what? Take profits. That's all. So your stop loss, this stop loss you are seeing is the amount you are risking. And this take profit you are seeing is the amount you are gaining. So if I put my stop loss at $2, once the market goes against me, the market decides to fail, it's only $2 that I'll lose, that will get withdrawn from my account into the market space forever. Like $2 will just, I'll make a loss of $2 alone. And if my take profit is at $8, once the market gives me $8, it will close my trade. Even though I'm not in front of my system, the trade will close. It will exit automatically on its own. Because if you don't set a stop loss, let me tell you something. Some people are fond of entering the markets and they will not put a stop loss. If you don't set a stop loss, let's say you have $100 in your account. If you don't set a stop loss, as the market is going against you, as it's going against you, your money will be reducing. And because you may not be there in front of your computer or in front of your phone to look at it reducing, your money can blow out and your account can empty out and your account can get wasted before you come back to your computer screen. So to avoid that, put what? Your stop loss. Your stop loss will just set a fixed price or a fixed amount that you want to lose per time. If that amount is hit, let's say you set your stop loss at $2 and the market goes against you and you lost $2, your trade will automatically close and your remaining balance will be kept safe. Also, you need to put a take profits, because if you don't put a take profits, you may think that price will be going forever in your direction, which is not wise. At some point in time, price may come back against you. So it is best to put a take profit, so that once you meet that target in profits, the market words, your trading terminal words will just close your trade and keep your money, keep your profits in your balance for you. So that's all for today. Thank you very much. I believe you must have gotten a brief summarized version of this entire thing. So this is what happens in the forex space. So it's not hard. So I know where the majority of the work comes in is, I know in the previous videos I've handled point 1, how to know the current state of markets, and in the subsequent videos that I'll be doing, this point 2, I'm still treating it. Oh, in fact, I've treated point 2 already, but I'm not doing point 2 entirely. But currently now I'm in point 3 in the videos we're making currently. So I'm in point 3. Once we're done with point 3, point 4 will be the next thing. You understand? All right. God bless you.